All right, welcome back. We're going to do this again, mid-quarter roundtable. So middle of the third quarter, 2024. And this time in our new podcast studio, we got our first guest from Invesco. I'd like to welcome and introduce Brian Levitt. Brian?
Yeah, happy to be here. Thank you.
Great. So let me tell you a little bit about Brian first. Here's his bio. Brian is a global market strategist at Invesco. In this role, he specializes in developing investment outlooks and analyzing timely market and economic themes to determine what may have an impact on investment strategies for both financial professionals and investors. Mr. Levitt helps financial professionals connect with their investor clients by providing clear context and communicating investment views using practical analogies and stories. He's the author of Invesco's compelling wealth management conversations program, which seeks to help investors manage emotions and stick to their investment plans, as well as the firm's financial literacy program, which is designed to educate families on personal finance. Mr. Levitt co-hosts Invesco's Greater Possibilities podcast and is the author of Invesco's Above the Noise monthly newsletter. He's often quoted in financial services media, including Barron's, Financial Times, The Wall Street Journal. He's a recurring guest on CNBC, Bloomberg, and Yahoo Finance, so you may have seen him before. And Mr. Levitt earned a BA degree in economics from the University of Michigan and an MBA with honors in finance and international business from Fordham University. And we're glad to have him.
Yeah, I'm happy to be here. Thank you.
Perfect. Well, let's talk a little bit about, market recap's always one of the first things we do. Just so, again, if people haven't been following it, kind of where we're at, currently, really since the last podcast. So about 3 months exactly, I think, to the date and year to date. So Kyle, you want to do that real quick?
Yeah. So kind of just looking across the markets here around the Dow, we're about 7.3% roughly since our last podcast, and really about 10% year to date. S&P about 6.5% since our last podcast, and 18% year to date. NASDAQ, the tech heavy, which has really been driving the markets for the year, from what we were seeing at the start, kind of did slow down a little bit since our last podcast, was only up 4%, and now brings it about 17-18% for the year. And our bonds, I think we can celebrate a little bit. We're finally seeing some positive returns in the bond market, up about 6% since kind of that mid-May range to now, and 3.5% for the year. And commodities, which kind of bailed us out a little bit the last couple of years with inflation, still positive 2% roughly for the year, but since that mid-May range, it's down about 6-7%. So pulling back a little bit here.
Yeah. So I thought what we'd do here is just kind of use Brian as a resource and talk through him, and then we'll see what we learn and join in from there. So I think the first thing, market performance, which we kind of went over, Brian. How would you characterize the markets so far this year?
It started off as a very heavily concentrated market, and I would argue that was because all the expectations for a broader market, a small cap rally, all happened in November and December. So if you're like me and you write outlooks for a living, by the time you got it out, the 20% rally in small caps had already happened. And a lot of that was because of the expectations for 6 rate cuts. Now, the market then had to back that out. So if you think of what a lot of the first half of the year was about, economy was pretty resilient, and the market was backing out those 6 rate cuts. And that type of environment, the mega caps did well. It was really the market was saying small caps value. They may need some rate cuts to help them out a bit. And I would say more recently, the market's enthused that the Fed can lower rates here, and there's not going to be a recession. So this market lately is a soft landing trade more, meaning, again, Fed lowers rates, economy plows through, and broader participation is the result of it. And it's not as if the broad market or the tech names haven't kept up, but they've participated, but they haven't kept up as much as value and small caps and cyclicals have done as of late.
Brian, kind of, piggybacking off that, I know that clients have kind of that short-term memory a little bit sometimes. And so we met last time in May. We're kind of giving year-to-date numbers, but a lot of people still remember that early August time period when we kind of had a little bit of a pullback or correction in the markets. Any thoughts on kind of what triggered that, or if it was just kind of a blip, or what we're looking at going forward for the rest of the year?
5 to 10% corrections happen almost every year, and the market tends to recover in about 3 months. So they're never fun when you're going through them. They tend to happen in most years. Now, they don't come out of nowhere. They're almost always the result of policy uncertainty. And typically, that uncertainty is in the United States. Usually, it's driven by the Federal Reserve or perhaps something going on in the executive branch, but it's usually policy driven in the US. This time, it was more focused on the Bank of Japan. Now, I thought the Bank of Japan had telegraphed that they were going to raise rates a quarter point for the first time in decades. But clearly, some investors were caught off sides with regards to the so-called yen carry trade, borrowing money at nothing in Japanese yen and investing in speculative assets. So when the Bank of Japan raised rates and it was unclear how much further they may have to raise rates, there was some unwind of it. And Bank of Japan calmed it down very quickly, saying, we are not going to be raising rates beyond this, or certainly not significantly.
Yeah, that's been talked about quite a bit, the yen carry trade, and you kind of mentioned it. So basically, Japan's had zero interest rates forever. So borrowing in yen and then investing in other currencies to make money. And that's what, again, this is a jargon that's out there, and people don't always understand what's going on. So is there anything else to it besides that, or that's just basically it?
Yeah, you borrow money where you can get it cheap, and you invest it where you think you can get good returns. And so a lot of that was the AI trade or big tech stocks, and so there was nothing really fundamental about the U.S. economy that drove it. Some said maybe one bad employment report. That employment report didn't seem all that bad to me. Some said maybe the AI trade was just getting too long in the tooth. The reality was it was more technical than that. It was, investors perhaps getting margin calls from what was going on as interest rates went up in Japan, and you sell your winners to match that.
That makes sense. So obviously we'll get into elections in in a little bit, but on that note, everybody, depending on what side you're on, you're seeing a lot of political ads right now, and one side the economy is absolutely terrible. It's the worst possible economy we've ever been in, and then the other side, it's it's the greatest economy. Look how great everything's going. Where would you say we're at economy wise? How strong is the economy right now?
That's a pretty good economy. Hopefully that's not a political statement. It's a pretty good economy. It's an economy that has a fairly low unemployment rate. Jobless claims remain pretty well contained week to week. The consumer still spending. It's not going to be as good of an economy as we saw through 23 and some of this year. I mean, things slow. That's the idea of it. I mean, remember, consumers had a lot of pent up demand coming out of COVID. There's only so many vacations we can take, and I don't know about all of you, but I'm getting a little bored of going to restaurants. Like we came out of this, and all everybody wanted to do was eat out. I'm ready to start barbecuing again. So we'll slow, but there's nothing heading into the election to suggest that this is a weak economy. I think people may suggest it in the polls because the high cost of living. Right now, that's a challenge that American consumers have had to grapple with. But to say that the economy is not growing at a reasonable clip is inaccurate.
So did that? I know that, again, things that people hear and are in the news. So the recent revision of, I think they missed by 1 million jobs.
Rounding error.
That's a fairly large miss. I mean, does that weigh in at all? I mean, does that change your mind at all, or is that it's again, they're political talking points, but we want to know the difference between a true political talking point and a real economic issue or non-issue.
I always take non-farm payrolls with a grain of salt. It's always a little bit frustrating to me, particularly some of the weeks earlier this year and months earlier this year, where you would get a blowout non-farm payroll report, meaning how many jobs were created in the month, and that would cause interest rates to go up and the market to sell off that day. And we always know these numbers are going to be revised, and a lot of these numbers are estimated. There's other ways to look at it. You can look at ADP's numbers. They actually hand out the paychecks. Now, they don't hand out the paychecks to everyone, But they put out a report, so maybe that's a little bit cleaner. I would say pick a metric, pick an index, and stick with it. Don't change. But no, I mean, this is an economy that has still created an awful lot of jobs since the COVID environment. We have seen the number of job openings come down pretty significantly. Most Americans who want a job can have a job. So no, the fact that we revised, again, revision should be expected. And given what you see from the U.S. consumer and the resilience so far, it's indicative of a labor market that's been quite strong.
Hey, Brian, if the job polls or the job numbers are truly estimates and we expect them to be revised, why do you think it is that they're typically revised downward? If it was random, wouldn't we have some revisions up? But I feel like, and maybe my memory is short, but I feel like all the revisions are downward, and so I don't know if that's a political play or not. But do you feel the same thing, or is your memory better, where you remember there's been a lot of revisions up?
Yeah, there's probably been some revisions up. I don't know if I've thought about that all that much. There's probably been some revisions up. This is not about the U.S. government trying to help one side or the other. There are not people, in my opinion, working at the Bureau of Labor Statistics or the Bureau of Economic Analysis that are trying to skew this one way or another. They have a formula. They're doing a birth-death estimate, which is basically how many businesses do we think were formed versus how many businesses went out over this time period, and they try to estimate the number of jobs, among other things. So whether that skews to downward revisions, I'm not exactly sure, but I really want to be clear with people. There is not anything more backroom going on here. There's not a deep state thing going on here. People are happy when their president is in power and the jobs are going up. They don't want to believe it when their president's not in power and the jobs are going up.
Take them with a grain of salt. Are there certain indicators that you like to stare at most when it comes to the strength or weakness of the economy?
Yeah, I mean, the first thing you want to do is take a look at where are you in the cycle. And so you want to know if the business cycle has room or if you think it's coming to an end. Typically, what you look at, if you focus on leverage or excess in the economy. So leverage would be things like business borrowing, consumer borrowing, bank balance sheets. Currently, that's all fairly healthy. Excess would be like businesses having too much inventory, the nation having too many homes available. None of that's the case. Rather, what we've had this time, and what you usually then look for after the excess has built, is short-term interest rates going above long-term rates, the so-called inversion of the yield curve, which historically is a harbinger of bad things. Now, in this instance, rates went up because of inflation, but that inflation really happened because we just didn't have enough stuff in this country following COVID. So yeah, we do have an inversion of the yield curve, which could be disconcerting, although most Americans have not really felt the impact of higher rates because most of us have fixed rate mortgages. From there, usually when the yield curve inverts, you start to see signs of survey data really collapsing, whether that's manufacturing survey data, consumer sentiment. For the most part, that's not the case. I mean, things are pointing to slowing growth, but certainly not recessionary levels. And a critical one to look at is corporate borrowing costs compared to risk-free rates. We call that the credit spread. So if you're a business, what do you borrow at compared to short rates? Usually that goes up significantly ahead of a recession. It's the so-called canary in the coal mine. It gives you the warning. That's not a problem that's not a problem at all right now. And if there's any animal lovers on the pod, let me just make it clear that we no longer use canaries in coal mines. We have electric devices now that can detect toxic gases. But anyway, our preferred canary in the coal mine is not squawking right now.
That's great.
I don't think that. Well, I wonder if once we get back to a standard yield curve, I mean, because I can remember on CNBC and everywhere that the moment we went inverted, all it is blasting red across the screen, right?
Only it's been 2 years now,
Like,
right?
like here's your sign, here's your sign. Get out of the market, get out of the market. We have an inverted yield curve, and here we are.
Yeah.
What are we? 2 years, Brian?
Yeah.
Inverted?
Yeah.
And so I wonder if the strength of that indicator is, if we're just like in a unique time, and that indicator is still a good indicator.
We're by all means in a unique time. This is so.
But I mean, aren't we always?
Well, we are, but these last 4 years are so bizarre. We shut down the global economy. Our policymakers freaked out and gave a lot of people money, a lot of businesses money, literally at the exact moment that businesses were cutting workers and slashing inventory. And we all went on a spending spree, and nobody had workers or anything on the shelf. And by the way, the emerging markets had 0% vaccine rates. Right. And so until all that got solved, we had money burning holes in our pockets, sitting at home doing nothing all day, and we wanted stuff. And so we got inflation for the first time in 40 years. We can blame it on Trump. We can blame it on Biden. Doesn't matter to me. The reality was too much money in our pockets and not enough stuff to buy. So what happened was the Fed had to raise rates. And what was so unique about it, the Fed needed to slow things down. You usually raise rates at a time of leverage and excess. So if I've borrowed too much, if I'm a business owner or I'm a household and I've borrowed too much, the rise in rates should really hurt me and slow me down. But the difference this time was nobody was levered up, right? I have a mortgage. It's not a small number. I haven't felt it at all. I have a fixed rate mortgage, right? And I'm sure a lot of people feel the same way. Businesses, operated the same way, refinanced at very low rates. So it may not be that the yield curve going forward is a bad indicator, but rather suggests that there wasn't as much leverage in this economy. Now, we're starting to slow. And so at some point, businesses have to roll debt. At some point, maybe some consumers that have floating rate mortgages on the margin get hurt by it. And so things start to slow. The idea here is, though, that they don't crack like they do in past environments, and they don't crater like they did in something like 2008.
Yeah. Makes sense. I think one thing you said is important too, is like, it sounds like you make a differentiation between the economy and inflation, basically the cost of living. I mean, yes, prices have gone up. Things are more expensive, but that doesn't mean the economy is bad.
But I think
they're mutually exclusive, right?
To us, right? But you talk to like the average American, if you ask them.
No, I'm not saying it doesn't hurt them, but he's talking about
right. I agree, but I'm talking about like sentiment. When you ask the average American how the economy is doing, they'll tell you it's awful because their grocery bill's up.
Right.
Because their grocery bill's up. So
they correlate the two, or they lost their job or something like that. It's very personal.
If you add up GDP, right, it's consumption, business investment, government spending, net exports. Consumption, business investment's been fine, right? So you would look at that and say, if you do what we do, economy's fine. Now, prices have gone up. The thing about that is the rate of inflation has slowed significantly. So yeah, prices have gone up. I'll give you an example. I was in Beverly Hills and I ordered a glass of wine. It wasn't a special glass of wine, and it was $24. And so I was holding it when I was presenting to investors, and I was talking about low inflation. It had come down. And they said to me, well, what did that glass of wine cost you? I said, $24. And they said, how could you say there's no inflation? I said, well, what would this glass of wine have cost me last year? And they said $24. I said, okay, that's 0% inflation. So it's not that I'm not empathetic about what Americans' households are going through. I am. I'm living it myself. But what the Federal Reserve wants and what the U.S. markets want is price stability. So what the Federal Reserve has been able to do is return us to price stability. They're not going to bring prices back to where they were. No president is going to bring prices back to where they were. But instead, what we have now is price stability, which is what the bond and equity markets are looking for. And that's a huge improvement from where we were in 2022.
I think that's an important part too, Ryan, is we always talk about the inflation numbers as they come out, and it's that year-over-year change, and or the rate of increase is down. But if we just look at cumulative inflation for the last 3 or 4 years, really, it's still up over 20%. And so, like you said, that glass of wine last year was still $24, but 3 or 4 years ago, before the inflation cycle, it may have been 16. And so
Exactly. And you
consumers are
also have to
still
look.
experiencing the inflation as far as spending goes.
Yeah, but you also have to look at, have your wages kept up? And in aggregate, the data may say it has. Many Americans may not think it has. And you talk to your friends and family, and when they get a raise, they feel it's deserved, right? I earned this. But when they get a cost of living adjustment, it may be. This isn't fair because I should be able to spend more as a result of it. We'd all like that. It doesn't always work that way, but again, in aggregate, it suggests that our wages have generally kept up. Now, when that starts to turn, and maybe it's turning a little bit here, that's when consumerism starts to slow. So far we've been okay. But I want to be clear. I do expect a slowdown in the economy here, which isn't necessarily the worst thing. It was precisely what the Federal Reserve wanted.
Yeah. On that note, why don't you talk about the difference between a slowdown in the economy versus a recession?
Okay, so there's the different types of market events that happen for different environments. We talked about the 5 to 10% where you recover in 3 months. That's more around policy uncertainty driven volatility. A slowdown, you may see something like that, maybe a little bit more if the market gets concerned. Maybe of that 8 to 12% variety, and you recover in about 6 months, or maybe quicker than that. A recession is, if you have a minor recession, historically you lose about 20 to 25% of the broad market value, and it takes you a year or two to recover. If you have historically a severe recession, like a 1973, like a 2008, you can go down 50% and not recover for a half decade or more. So I'm going to be clear. There's not enough excess in this economy to be one of those severe recessions. A minor recession, the market kind of priced that in 2022. Right, we went down almost 25%, and the market's forgotten about that now. It's taken out the high. It's a market now saying we're not going to have that recession. If you get a slowdown, don't be surprised if we give back a little. That, to me, would be a buying opportunity. Quite frankly, a mild recession would be a buying opportunity to me. But it feels right now more of a slowdown. Right now, the market is more focused on the Fed. So the market is enthused that the Fed may lower rates. If the market turns its attention to the Fed's not doing enough and the economy slowing, then you might get a bit of a drawdown. But again, I would view that as a buying opportunity.
I think that's another little transition there for us too, Brian. You mentioned the Fed and everybody paying attention to monetary policy and what's going to take place. We kind of started talking at the beginning of the year that they were pricing in potentially 6 rate cuts. Then it went to 2, then 0, and then that the stuff happened back in August, and now all of a sudden people are calling for full 1% in the next 3 or 4 months. So the Fed funds futures market's kind of all over the place now on what the predictions are. But looking at things today, they're pricing in almost a full percentage point over the next 3 or 4 months. Kind of what are your thoughts on that? And do you see the Fed being that aggressive? Do you think it's warranted?
Well, I suspect they'll go a bit slower than that. So the market might be a little bit ahead of itself. But we're going to be lowering it. So if you're investing over the next couple of years, you should be, I believe, comforted by the fact that we're now in the easing environment. Could you have some growth trip up in the easing environment? Yeah. But the easing environment, the end of tightening, is usually good for markets. And so far, that has been the case. So even if there's near-term volatility, I would view it as a buying opportunity. The risk we have, right, the Federal Reserve raised rates 525 basis points, 5.25% in a short period of time. And we're still waiting to see the type of ramifications of it. So far, the economy's been resilient, and we've been able to move along through this environment. Now, we are going to slow. We don't know the full extent to which we're going to slow. And could it be, if the Fed keeps rates a bit elevated for too long, that they do derail the economy? That is a risk. And quite frankly, if I was the Federal Reserve, I'd be getting out in front of it. There's no reason to risk a recession. I don't believe inflation is a challenge in this country anymore. The risk to me is on the growth side. I'd like to see them get going. I think policy is too tight for the environment that we're in. They're going to go at their own pace. So does that raise the risk of a slowdown becoming a recession? It does. It's not my base case, but it does raise the risk.
So one thing I get a lot, and I think this is, again, something that's in the, in the news or people, hear all the time. How about government spending? This is something I kind of want to talk about. Like, I mean, are you concerned about, increasing government spending and the growing national debt? And would you consider that a near-term problem, or, is it a longer-term problem?
I'm actually one of the few Americans who's not remotely concerned about the debt. It is a very frequent question I get. I've literally never lost a moment of sleep about the debt. So let me try to explain quickly why. The first thing is, when I joined this industry, the debt was 5 trillion. I was told it was a problem. Now it's 35 trillion, still not a problem. Low rates in this country, strong currency. A lot of the growth in that debt has come in the last 15 years. Most of that was administrations responding to crisis. So 2008 financial crisis and COVID. Think about where we are right now with a reasonably good economy. Where would we be had we not responded with borrowing and government stimulus? So I'm happy to live in a country where we do that and counteract the business cycle. But yeah, 35 trillion is a large number, but you have to put it into some perspective. If as a homeowner, if I told you that I borrowed $1 million, you wouldn't know whether that was right for me or not. If I told you I borrowed $1 million and I only had 100,000, you'd say it's a problem. If I told you I borrowed $1 million and I had $20 million, say, okay, fine, no problem. So what is the total household net worth in this country? Most people don't know the answer. It's over $150 trillion. So when you look at it from that perspective, government debt to the total household net worth, not a large number. This is a very wealthy country. And then fourth, there's a very captive audience for U.S. debt. So who owns the debt? It's federal entities own the debt. U.S. banks have to. U.S. insurance companies have to. U.S. pensions and endowments and mutual funds have to. And yeah, foreign investors, yeah, but it's the Japanese and Germans who love our yields. So no, I'm not concerned. I don't think there's not going to be this moment in our lives where we wake up and there's a Lehman Brothers moment about U.S. government debt. No, that's not how this is going to work. Could there be a moment in the future where we have to make adjustments to Social Security? We have to change the tax code? Possibly. But there's not a moment of comeuppance coming. I've been hearing about that moment of comeuppance most of my life. And we still borrow as a government below 4% and have the world's strongest currency.
Part of the question too, and again, these are things that we hear from clients or popular, what I would consider myths, that the dollar's fading, we're going to lose our our standing as a global reserve currency. So I think you kind of explained that, but is there anything else? I mean, is it relative to the rest of the world? Is that basic? Again, people worry about what's going on here, but then they don't think about it in relativity terms to the rest of the world.
Yeah, you have to think about where we're going. So, countries tend to have when they get the reserve currency, you tend to have it for quite a while until another major economy emerges to become the world's biggest economy, the world's biggest military power. And so you think about it, the British pound sterling had that reserve currency status until Europe became largely destroyed from 2 world wars. The U.S. emerges as the strongest economy, and for a very long while, there was no competition to that status. Now, people look as competition to that status as a bad thing. We should want to grow the pie. We don't want the US to be 50% of world economic activity. The fact that we're 20 to 25% of world economic activity is better, right? When other countries emerge, there's a greater pie, there's more customers to sell to, etc. So it's not a bad thing, but you have to ask yourself, well, reserve currency, where else are you going to park your money? So Europe makes sense, big economy, military, but they don't have a fiscal union. They don't have FDIC insurance. So not a great option. China, very large economy, but China doesn't have a free flow of capital, so it doesn't allow them to emerge. That, and China may, they talk about combining with Russia or Brazil, but Russia has its challenges. Brazil's policies historically have been challenged, so there's not really another alternative at this point. And the final point I would make is that people think of it as if the US dollar loses its reserve currency, that's it. That's the end of the US. First of all, I don't think it's going to happen in our lifetimes, but think about the British pound sterling, right? It was 1945 that they lost the reserve currency status. Is that a weak currency? I think the UK is like the 7th largest economy in the world, or maybe that's California, but something like that, right? They're in the G7, a very large economy with a reasonably strong currency. So again, people think it's like this unbelievable danger. That's not how this works.
I think it's worth mentioning too that again, this is elementary for our level, but the global reserve currency is not something that's voted on. This isn't like the UN gets together and people go, which one should we use this year? Well, we'll use the dollar. I mean, it's a result of what's happening in the world. People vote with their money. Where the money goes determines where the global reserve currency is. So again, it's not something that we're going to lose by vote. If people feel comfortable with dollars, no matter what's going on in the U.S. economy or the government, whatever else, then dollars will remain the global reserve currency until it's not.
Well said.
Federal government. Let's talk. So we kind of talked a little bit about federal government, but let's start talking about election, because this is and I think this seems to increase every time we have an election. I don't know if it's access to news media or social media, or everybody's got 24/7 access now. But election and with the polarization of both sides is pretty much on everybody's mind. So are you concerned about the markets as it relates to the coming election?
No, I'm not. And I'm going to give you a stat. So President Biden was elected president 957 days ago. And the market, the S&P 500 is up 65% over those 957 days. So that's from November 3rd, 2020. Any guesses what the market was up from the 957 days after Trump was elected in November 2016? 65%. I mean, you can't make it up. It's stunning how they're sitting right on top of each other. So people worry every 4 years. I mean, I was told Obama was going to be bad for the markets. I was told Trump was going to be bad for the markets. I was told Biden was going to be bad for the markets. Now I'm being told Kamala Harris is going to be bad for the markets, or Trump 2.0 is going to be bad for the markets. The market cares about the direction of the economy and what the Fed is going to do. The market is not overly concerned with the executive branch of government.
Yeah, we agree, but I mean, we get hammered every 4 years, right? Because every political candidate, since there's ever been a political candidate, runs on the same campaign that everything is awful, but vote for me and I'll fix it.
Yeah.
And so when everyone hears that over and over and over again, the sentiment is awful. Everyone thinks that if their candidate doesn't win, then everything's going to come crashing down. But obviously,
and if you think about the last 8 years, and that's why I like to do that stat on Trump's performance over the first 957 days and Biden's, in 2016, Hillary Clinton said if Trump wins, he'll treat the economy like one of his casinos, will all go bankrupt. And then Trump said in 2020, if Biden wins, your 401k will go to zero, the market will go to zero. and they've both had the exact same performance over the first 900.
I'm gonna tell you, Brian, you're not gonna win any friends on either side, Brian. You're way too much in the middle. I mean, it's got to be like, it's got to be, one is terrible, one's great. That's the only way it
goal
can
is to
work,
upset
right?
everyone. Well, look, I mean, we all have our.
It sounds like
the
market really doesn't like. The market really doesn't like the end of presidencies. It just sort of ends up dipping at the end, and then sets up the next person for a pretty good run.
Might have something to do with uncertainty going forward.
No kidding.
How about if we get a little bit more, outside of just broad market? Are there specific sectors or industries that might benefit from one candidate, or I guess one side or another?
I hesitate to make those obvious sector or industry calls. They tend to not be right. I was trained in this, focusing on where you are in the cycle, direction of the economy, what the Fed's going to do. And it's pretty rare that who's the president changes the answer to those questions. For what it's worth, it's also pretty rare that conflicts around the world change the answers to those questions. So it's hard. I don't love to do it. And I'll give you an example. If we had spoken, if this podcast was being recorded November 2016 when Trump won, and we went around, the five of us, and said, what's going to do better, traditional energy or clean energy? I think most of us would have said traditional energy. Probably 5 for 5 would have said traditional energy. Well, traditional energy was down 50% under Trump, and clean energy was up 150% under Trump. Now, on the flip side of that, if we had spoken the week that Joe Biden won in November 2020, I think 5 out of 5 of us would have said it was better for clean energy. And yet clean energy is down under Biden. Traditional energy is up over 200% under Trump. And in actuality, the U.S. now drills more barrels of oil per day than any country in the history of the world ever. So, sometimes these obvious sector or industry calls, actually often, don't play out the way many people suspect they will.
So what you're saying is you can't really predict the market. We've never talked about this before.
Well, it's not. I mean, it's not that you can't try to. You can't try to use the tools that you have to think about the market. So if I know with absolute certainty, if my indicators tell me no recession, inflation's coming down, the Fed's going to ease, no recession, then I have a decent sense of what market leadership's going to look like. I would expect broader markets, cyclical, small cap value to do well. But that doesn't matter to me if it's Donald Trump or Kamala Harris.
So let's talk market outlook a little bit. Where do you see markets? Obviously, this is best guess type stuff over the next 12 to 24 months. And we talked a little bit about this is a pretty unique period, but is there any other period in history that is, at least similar?
Well, I'll give you two. I do expect the markets to be higher over the next year and two. And that comes back to my point that once you have peak inflation and peak interest rates, the markets tend to do well over the subsequent years. And that's certainly been the case so far. Somewhat, you can think of 80, 81 or 94, 95 as perhaps reasonable analogies to the current environment. 80, 81, an inflation environment where the Fed raised rates pretty significantly. You did get a recession, right? So you did have to come down 25%. But market did great. Even though you had to deal with the recession in 81, if you invested when inflation peaked in March 80, you were thrilled over the next 5-7 years. So that's one. The other one would be a 94, 95, where the Fed raised rates by 3% to bring down inflation and then stopped and slowly lowered rates a bit, not a lot, but slowly. And the market sold off a bit during the tightening, but then went gangbusters in the years after it. So it's really a question of, in my opinion, hard landing or soft landing. It's a question of whether we need to give back 20% before going higher, or we do a garden variety 5 to 10% down again before going ultimately higher. But either way, I come to the view that this is a market that has room to run. And when you look back a couple of years from now, it's more likely than not that markets are higher than they are today.
What about income-seeking investors? Obviously, a little different than your traditional longer-term investor in
Well, the
in
one
this market.
challenge that income-seeking investors have, it depends how they're positioned right now, but you see people like money markets. They like, particularly if they're at the regional banks, they like their bank deposits because they're getting nice short-term yields. But that, if you like something for 30 days, you should probably want to like it for 5 or 10 years. And, the problem with short-term paper is that you're going to have to roll it. And so we all kind of have a sense of where the Fed's likely to take rates. So we call that reinvestment risk. Now, in 2019, people were begging me, they were probably begging you for 4%. And in order to get a 4% yield in 2019, I used to have to tell people to buy high yield bonds, which are, are riskier in nature or have higher default rates historically, or I had to tell them to lend money to the Russian government. So it wasn't that easy back then. Now you can get, 4% or higher in corporate bonds, in municipal bonds, in a total return bond portfolio. You can get 8% in high yield, right? That's almost equity-like. So investors should think about what they're targeting with regards to income and how they could build a diversified mix to get the income that they want, rather than being, sitting here with the reinvestment risk that they. I'll give the example. My dad talks about the early 80s when short rates were 18% and 30-year rates were 16%. Right. And he didn't want to lock in 30-year at 16% because he thought rates were going a lot higher. And as a result, the Levitt family I had to grow up in modest means because he wasn't getting his 16% a year. And what happened? That 18% went all the way down to zero by 2008. Right. So you reinvested all the way down to nothing. So that's the risk. I mean, versus what if I could have had that 30% for 16 years? 16% for 30.
16,
Willy Wonka,
30 years.
strike that, reverse that. You know what I mean? And now 4% is not 16%, but it's the same concept.
How about I know something you've already mentioned in examples is housing, right? That rates have gone up, but people haven't really felt it because they have fixed rate mortgages. What about, are you concerned at all about, or how do you think it impacts, the markets, the economy with the current state of housing? Because that's good for people that are in houses, right? But it also creates a lack of availability, supply, and it also, forces people to stay where they're at. So housing is slowed down quite a bit. I know we're lacking supply, and is that an issue that you see in the near term or maybe in the longer term?
Different question with that too. Is there a number that you expect a refi wave to come through also when the 30-year gets down to a certain number?
Yeah, we have good demographics for home buying. It is this country's a lot of 30-year-olds and a lot of 60-year-olds. So there's none of me. So maybe that's how I got into college. Nobody else was applying, but a lot of 30-year-olds and a lot of 60-year-olds. So what was supposed to be happening was the 60-year-olds would downsize and the 30-year-olds would buy the homes and we'd build the extra that were needed. 60-year-olds, to your point, haven't really moved to the extent that many had thought because if they had to borrow money to buy something else, it was pretty prohibitive. So you haven't seen a lot of supply, and yet the 30-year-olds, a lot of them wanted out of the city. So anytime you saw something come to market, it got bid up pretty quickly in a lot of places. I think what starts to happen now, rates come down, you'll see more homes come to market. You'll see more of that 60, 70-year-old cohort looking to move. And so you'll have a better supply demand environment than you have, which means prices, don't go up the way they've been going up. Things slow down a little bit, which is okay. The good news for housing over the next 20 years is we just don't have enough homes. And so you're seeing construction, and even if things slow down a little bit, we're going to see housing as a tailwind to this economy over the next few decades.
So you don't. So you don't think so? Lack of affordability for young home buyers. Again, they do those charts all the time that used to be able to get into your first home on one income, one family income, and now a lot of people are locked out of that due to both price of of existing homes and rates.
Yeah, there will be some of that. The good news is rates will come down, and to the point, yeah, you will see refinancing for those that didn't refinance in 2020. But you'll
Right.
see, people who will think that mortgage rates going from 7 to 5 is now a great deal. It's all relative. I mean, who among us thought we could afford the home we bought when we bought it? Right. I mean, you can go back and probably talk to any of our parents who bought $30,000 homes and were terrified to do it. Right. And so I think that's just how it goes. I don't mean to sugarcoat the difficulties you have in forming a household now, but I think most generations felt challenged in buying their first homes.
Interesting.
Yeah. So just so everybody knows, mortgage rates, were at a high of basically 7.8% in October of 23, and just recently they're at about 6.46. So rates have come down. Mortgage rates have come down. Just obviously, we're probably not going to see that 3%, 3.5% mortgage for a really, really long time, maybe ever.
Forever. On the mortgage rates, and Brian, I don't have the data in front of me. Maybe you have it off the top of your head, but I remember reading a while ago that a 30-year mortgage used to follow pretty closely to the 10-year treasury. There used to be a spread there that was pretty common. But then when the rates jumped up the way that they did, that spread also widened. Do you know if that spread is still pretty wide between a 30-year mortgage and a 10-year treasury, or has that been tightening a little bit where we could actually see rates come down a modest amount, but mortgage rates actually come down significantly?
Well, you just quoted 6.4 on the mortgage rate, and the 10-year treasury is around 3.8. So that's still a decent spread. I
Right.
would expect rates to come down and that spread to narrow.
Do you have a guess as to why that spread widened the way it did? Is it just the banks afraid of the risk?
I think so. I think for concern perhaps of what the value of the dollar was going to be worth in the future. I mean, you're lending money for 30 years in an inflationary environment. What's to the bank, what's going to be the value of that going forward? So that starts to highlight some of the challenges of price instability. Now, when you start to see, again, high cost of living, but the change in prices at 2.5 to 3%, it's a lot more manageable environment.
Top questions from clients.
I've got one.
We can ask for Brian. Well, he's here.
Well, we've got, this is obvious stuff that's hitting the news too, right? And so, we've kind of, in wrapping this up and echoing your point in the sense that things look okay, not great, not bad, but the economy is definitely healthier than people might think it is. What would you, if you had to speculate, if you had to guess, obviously, we've heard with Buffett and the headline there, sitting on the largest cash pile he's ever sat on. Now, even as a percentage, it's the largest percentage of cash he's ever sat on. Any speculation as to what's going on over there at Berkshire Hathaway, why they're sitting on so much cash if we think everything is good?
I mean, they're value investors. So I think there's been two things. One, traditional value hasn't worked as well lately. And so, to the extent that you look for maybe GARPier options, what we would call growth at a reasonable price, I think GARP may have disappeared from the market a little bit. Not that the top handful of names are overly expensive. I mean, a lot of them, the big companies that people talk about, the Magnificent Four, was it the Fab Four, the Magnificent Seven, whatever it is.
Changes between like 4 or 7.
4, 7, yeah. So, most of them have seen earnings keep up with price. So they're not overly expensive, but probably expensive for Berkshire Hathaway. So I would argue they're probably just not finding the type of growth businesses that they want at a reasonable price, and perhaps may have concerns of what traditional value will provide over multiple years. That
I
would be
think
my
too,
bet.
I think too, he manages it basically like an endowment, like it's forever, right? So he's willing to just sit on stuff until, for 5 years, 10 years, 15 years, until we have another. I mean, he cleans up in 08, 09. Probably did really well, probably got some great value in 22 also. So he waits for those type of moments, but the average investor can't wait 15 years to get in. So it's just a different strategy. I could be wrong. I'm not reading, I don't have a direct access to Warren Buffett, but it seems like that's pretty much his shtick.
And there's a huge opportunity cost to that. I mean, if you look at any 15-year period in U.S. history, the markets are positive 99.9% of the time. The only two observations are during the Great Depression. So if I had done that from 1945, it's 100% of the time.
Pretty compelling.
Also related to the markets, I mean, we started off this podcast talking about the returns year to date, and we've all heard about the S&P 7 versus the S&P 493. And so if it wasn't for ChatGPT, if it wasn't for the AI buzz that we've seen here over the last 12 to 18 months, I mean, where would this economy be, or specifically, I guess, even the markets? Would we be talking about the way that we're talking about it if it wasn't saved by AI? How do you feel about that? Do you think that's irrelevant, or do you think it is relevant?
Well, the economy has, let's not conflate the two. I mean, the economy, we've grown at a fairly good rate, right? And that's not being driven just by the AI story. That's being driven by a good employment picture. If you look at the equal weight index over the last year, it's up 17%. Over the last 2 years, it's up 25%. Over the last 3 years, 16%. So yeah, the S&P 500 has done better, but an equal weight index where you don't weight the companies based on market capitalization, you give every company 0.2%, you equal weight all of them, you still would have been positive in markets over the last couple of years.
Nothing else? You don't get as many questions from clients when the market's going up. They like that.
I'm getting a lot of them. So, and you covered a lot of them, which is the election and which side and the debt and the dollar. And so even when things are good, I still hear a lot of concerns, and clearly you're hearing the same ones.
Anything that you're getting that we haven't mentioned? It seems relevant.
Well, I think what's the risk to all of it? And we covered it somewhat, but the risk to all of it is that the Fed's got this wrong. Recessions they don't come out of left field. They're always the result of policy mistakes, always. And you could argue that the policy mistake happened in 2021 into 2022 when they let inflation out of the bag, because that means you've got to raise rates substantially. Now, to all of our points, it has not had the impact that many had feared. And I'm sitting here arguing it's because there's not a lot of leverage or excess. But it's still TBD, right? And in my opinion, the inflation story is 2022. That story is over. So I think if the Fed's sitting here saying, well, we're not sure, is inflation going to reaccelerate? No, that was a supply pent up demand story. Inflation's, to me, that's not the issue. The issue is the growth backdrop now. And let's get on with it. I mean, I don't call them because I know they wouldn't answer my phone calls, but it's time to start easing. And the risk to this is that they stay tight for too long. And again,
yeah, Brian, if they did take your call, right? The whisper now is 25 or 50 basis points, or 0.25% to 0.5%. If they did accept your call, where would you tell them to stick it, or at least put the rates?
I think you mean the rates there.
Right? Well, I would have already done a couple of 25 this year. I don't need to spook the market with 50 maybe in September, but I would want to start normalizing the yield curve. And so if short rates are if long rates are at 3.8, well, I've got to go 150 basis points to be below that.
Yeah. And where do you think they ought to settle?
Well, I would think of it from the perspective of is 4% fair value for the 10-year treasury? And, how do you get to what the fair value is? Usually it's representative of the nominal growth expectations for the US economy over the next 10 years. So can we do 2% inflation, 2% real growth? Yeah, or maybe even a bit higher than that. So 4.5 seems reasonable to me on the 10-year. Historically, the funds rate's 150 basis points below that. So what does that get you to? 2.5 to 3?
Right.
Yeah.
I want to follow up on something there you mentioned, Brian, because a lot of this we talked about when it comes to elections or parties in power, that, the markets are pretty resilient and they don't really care who it is. But you also just got done talking about policy leading to recessions and decisions made. Now, obviously, we're aware monetary policy and decisions made by the Fed are separate than politics. But I know that people listening, clients could hear, policy can impact, and they immediately go back to, well, if one party gets elected to the other, that means that's policy change, and that's going to be a recession. So can you kind of distinguish between the two there? What your thoughts are when you're saying policies have led to the recessions?
Yeah, thank you. I should have qualified it. Monetary policy typically leads to recession. See, the only thing the government can do is if they create a lot of uncertainty around where we're going, and consumers and businesses just can't make plans. Think about the trade wars in late 2018, where we just didn't know what the outcome was going to be. You could end up with a drawdown in economic activity because you're uncertain. But as long as policymakers give clarity, so as long as the government gives us clarity, like you might say, well, if Kamala Harris wins, we're going to lose the tax cuts. Okay, yeah, things might be slower as a result of that, but do we have clarity around it? That's what matters more with regards to the federal government. When I was saying that policy mistakes cause recessions, I meant the Fed, monetary policy side.
Perfect.
How
Thank
long?
you.
How long would you say those decisions? This is something, again, we talk to clients about a lot. That making a monetary policy decision. It's not like a light switch. It doesn't turn on the next day. I mean, how far out are those? If you cut rates or you raise rates, when do you really see the impact of those decisions?
18 to 24 months. Sometimes,
Okay.
we used to say 12 to 18 to call it 18 months. And so Fed raised rates 22 months. Fed was done raising rates 22 months ago.
Here we are.
Yeah, and here we are.
Or they inverted the yield
I
curve.
think like a lot of times people, again, not a longer term vision that, you do this and when, you hear that the Fed waited too long, well, again, it's what's going to happen over the next 18 months from today,
Yeah.
not what's going to happen over the next 2 weeks or in a month based on what they do the next meeting.
Yeah. And I don't ever I'm an empathetic guy. I don't want people to lose their job. I don't ever want to risk a recession.
Yeah. All right. So one of the things we normally do at the end, little bit of predictions. I think we've hit some good stuff. Brian's has some incredible insight. We just, again, part of the prediction thing is just, putting things out there and showing that, you may know some things, but you may not know exactly where it goes. So last roundtable, Jason, more volatility, little mean reversion. So I think we probably have had that.
We get a VIX spike.
We got the VIX spike.
Okay.
I was thinking about it later, pulling up charts for the clients on the VIX. I might lose them, but but yeah, we did see a spike in volatility, and usually, at least historically, that's been a buying opportunity when you see a VIX above 40. And we had a dramatic spike where, and Brian, I don't know if you can see this, but you're familiar with these numbers, where we saw the VIX jump from 16 to 40 nearly overnight, and then it gave it all back, and then now we're back. I think the VIX is now lower, which for those listening, the VIX is just a volatility measurement that we monitor to just kind of see. Oh, Brian could answer this better, but it's basically tracking the protection via options that those are looking or anticipating a downside or volatility in the markets, and so this monitors that. And then we actually had the fastest drop in the VIX in the last 30 years. Maybe 20 years now that I'm looking at that data, but nonetheless a big drop. And then when I tracked too how the markets reacted when the VIX drops as much as it does, I've got a chart here on performance going forward, and And now for the next, at least historically, when we see movements in the VIX like this, the next 90 days are a toss up. But that's to be expected. But it's batting 1,000 when you look 12 months out. So going back to Brian's prediction of where the markets might be a year from now, this would echo that.
Well, that makes sense too, because we also referred to the VIX as kind of that fear index, right? And so clients and panic and reaction to markets and news creates more volatility. And if it becomes more normal, you get more cash and stuff coming in from the sidelines, and markets tend to react positively.
Right.
Kyle, you said mortgage rates would be down. Value.
Man.
Kyle's just stuck
We
with
got
the
a crystal
value.
ball on this table.
Kyle's all about value.
Well, like I said, I think I've said that value prediction for 2 or 3 podcasts in a row. So I was never wrong. I was just early, right? So, so finally we did have the value kind of outperform growth, and that's from the kind of that end of our May podcast. And now, if we were cherry picking some of those periods of time over the last 2 or 3 months, there was some significant outperformance for value, but right now it's about a percentage point. So nothing overly significant relative to how far, how much better growth outperformed value over the last few years. But at least it's showing that, as we talked about a lot, that it is more of a broad market participation now, and not just kind of those growth positions. So, and yeah, mortgage rates. Yeah, I think we talked about it. It was not long ago. It was at that 7.75 number and come down about a point, it looks like here. So, yeah. Guess I got that one right.
Yeah, and Brian had a good answer on that. Just with the whole, mortgage rates, you probably should expect mortgage rates to continue to come down just because of, like you said, price stability.
Mm-hmm.
It's bank risk, and if they don't know where inflation's going and what their risk is, then you're going to get a bigger spread on mortgage rates over the 10-year. And now that's starting to come down, and the 10-year hasn't changed a whole lot. Chris, more M&A activity in tech. Did we have more M&A activity in tech?
That was awfully specific.
It was really specific.
How do you measure that?
You get more. Do you have anything on M&A, Brian? as far as M&A and tech? No, I think my point there was, I think with inflated numbers, with you take the top tech names,
Yeah.
they have money to spend.
Cash.
They have
Instead, they're just
cash.
doing
They have
buybacks.
cash, and that's what they're doing with it. They're buying their own stuff,
Yeah.
but they're not.
M&A within.
Yes. But yeah, I my guess is they'll probably do more of that because they still have cash. They have record amounts of cash, and the currency, as far as the stock goes, is still way up. It's higher than it was before. So we'll see where that goes.
Yeah, and then I've been staying with the no rate cuts in 2024, and now it looks like that run's going to come to an end. But the whole point there was that again, the Fed it seems to be moving slower than they used to move based on historical. It would throw out a token 25 here and there, and again they're stuck on that inflation number. They still haven't cut rates. Now Brian has said he expects them to. I think now we have 6 rate cuts priced in. Is it 6 or 4? A full percent.
Yeah,
a full percent priced in by the end of the year. So we'll see what happens. We probably won't get no rate cuts in 2024, but I wouldn't be surprised. So I'll start with next predictions. I wouldn't be surprised if we only get 2. And one would be extreme, but it just seems that they're just very, very hesitant. And I think it all comes back to inflation, and they feel like the economy is, doing well. And as we just talked about with Brian, that, hey, it's 18 months out. So you wait a little long, and then you can't get that time back. So it'll be interesting, but I think, maybe
I'll
2.
add to that too, because my prediction was going to be that we don't get a full percentage point by the end of the year. I do think that 50 to even 75 is probably baked in now, but I think that full percentage point, because they only meet 3 more times. And so I think
we only have
that's
3 more meetings.
Yeah,
Seems like
so I think
market
that would be
optimism.
pretty
Yeah.
aggressive. So
Jason, come on, you're 1 for 1. You hit last time.
Yeah, right. What I've seen here, I think there's going to be more. I forget the term Brian used, but kind of like a broadening out in the market. The first half of the year was all tech, and now what we're starting to see. I'll leave specific names and ticker symbols out of this podcast,
Please.
but what we're starting to see with some of these earnings, most recently one that came out yesterday, is this is a company that many would say is priced for perfection, and trading at all-time highs. And they actually beat on every metric on their earnings, and the stock was still down, showing just how priced to perfection a lot of these companies are. Like, they have to keep batting perfect, grand slam after grand slam, and that's not sustainable. And so I would expect that we start to see some broadening out where maybe people are starting to take a little bit of money off the table with some of these tech names, and we start to see some of the other companies have their day in the sun. So I could
Is
see
that a value prediction?
Yeah, that's well, it's a
sector rotation.
I would say it's more of like
Sector rotation.
equal weight catching up to weighted.
Well, and the growth rate thing too, we've talked about this. It's a math problem. Growth rate is not sustainable forever.
Right.
You have at some point it gets
You can't keep
you
growing
can't
at
keep up at the
100%
same
every quarter.
percentage. Exactly. So that by definition, eventually that does come down.
Yeah.
Chris,
I have nothing.
you got
I have
nothing.
nothing to
All right, we'll toss it to Brian. Brian, any predictions next? Call it next 3 to 6 months.
The election will pass without incident.
That's probably a pretty safe one.
The Fed, I agree, the Fed will not do the 4 rate cuts this year, and economy will slow but not go into recession.
I like it.
Perfect. It's good news for clients.
That's pretty optimistic. I like it.
Well, listen, we really appreciate Brian being on. I mean, if you listen to this whole thing, it's incredible insight, and he's an expert, but it kind of backs up a lot of the things that we say all the time, that nothing is ever as bad as it seems. A lot of this is a lot of the news is designed to elicit emotional reaction and drive fear, and it's a much more complex organism than boiling down to one or two things. So thought it was great.
Yeah, really appreciate your time.
Awesome.
Thank you.
Thank you, Brian.
Thank you very much,
Let me
Brian.
remind everybody, so reach out to us with questions. We won't always have Brian on here, unfortunately, but we'll be able to answer some questions on the podcast. Follow us on Facebook, LinkedIn, YouTube, or at our website at strongvalue.com, where everything's on there. And please share with somebody you think might benefit, or just like to laugh at us a little bit. I would say this one probably benefit. Brian's got some great information, and you don't have to wait for him to be on CNBC. You can listen to the whole thing right here.
Perfect.
So great time. We'll do this again in a couple of months for our last roundtable of the year. Appreciate it, everybody.
That's good.
Thank you all.
Thanks, guys.
Thank you.